Our last learning objective of Chapter 6 will cover the procedures or the techniques that we can use to estimate ending inventory. The two methods we're going to cover in Appendix 6B are the gross profit and the retail method. Now, of course, the first question is, why would you need to estimate ending inventory? Well, first of all, sometimes it's not cost effective to take a full-blown physical inventory during interim periods. So some companies may have weekly updates on inventory, they may have monthly financial statements, and it may not be cost effective to take a physical inventory at that time. In addition, you may be unable. The question could be that, the issue could be you're unable to take ending inventory because of a major casualty or theft or spoilage. So you may use estimating inventory, particularly for any type of natural disaster, hurricane, or any other type, perhaps even a fire, any type of casualty for insurance purposes. And of course, when that happens, not only is it difficult when there's a casualty, not only is it difficult to estimate ending inventory, it's also difficult to estimate the cost of goods sold. Now, the two methods that we're going to use, the gross profit and retail, estimating and ending inventory, actually by estimating cost of goods sold first and backing into ending inventory. So essentially, this is a reversal of the COGS formula. And we will estimate cost of goods sold and then back into ending inventory. And that's true whether we're using the gross profit or the retail method. Let's start with the gross profit method. Under the gross profit method, we know the beginning inventory from our inventory records. We know net purchases from our ledger accounts. And therefore, we can estimate, or we know the cost of goods available for sale. If we can estimate the cost of goods sold, then we can estimate the ending inventory. So notice we're just kind of flipping or reversing the cost of goods sold formula. So if ending inventory is in need of being estimated, well, obviously the first thing we have to do is come up with the estimated cost of goods sold. And we can do this by estimating the cost of goods sold. We know our sales revenue from our ledger, and we can use a gross profit percentage to come up with the estimated gross profit, and then from that we can estimate the cost of goods sold, which I'll show you in just a minute. So again, we have a simple modification of the cost of goods sold formula. Now, here are some numbers. Let's assume that the beginning inventory is 14. That comes from our records. And this is Smart Touch. And again, the inventory was destroyed by some casualty. So we can't physically count it. And now maybe we have an insurance claim. By the way, as I said earlier, another reason why you may want to do this is to try to see if you can uncover theft or spoilage. Theft sometimes is hard to target unless you can prove that inventory is short for some reason. And if there's a shortage in inventory, then you might be able to track it back to some kind of a theft or a pilferage. So you can't always count inventory in those cases. You might need a rapid response to a possible theft or fraud, and therefore you may want to estimate the inventory. In this case, we're saying it's destroyed. And we do have inventory records, so we know the beginning inventory, we know our purchases, and we know our sales. Now, here's the way we estimate the cost of goods sold. You would take something like a 5-year gross profit margin, and therefore you would say that if I have sales this year of $100,000, and I normally, as I said, maybe it's a 5-year average. So over the last 5 years, I've been averaging 40% gross profit on sales. I know that my estimated gross profit is $40,000, and therefore my estimated cost of goods sold is $60,000. You also could shortcut this a little bit. So you could say, well, you know what? I know that the cost of goods sold percentage is equal to 1 minus the gross profit percentage. So in this case, the COGS percentage is 60%. And therefore, if I sell 100,000 and I know my COGS percentage is 60%, I get the same estimated cost of goods sold. So either way would be correct. And in this case, we would come up with our estimated cost of goods sold, and now estimated cost of goods sold is 60,000. Now we've got our goods available for sale. So what we know so far is that the goods available for sale is 80,000. And now we have an estimated cost of goods sold. So now we can come up with our estimated ending inventory. If our beginning inventory and purchases are known, we have our cost of goods available that are known. We estimated the COGS from the gross profit percentage we had over the last 5 years, and we can now estimate ending inventory at 20. So that is the gross profit method. The other approach we can use is used by retail operations, and that's known as the retail method. Retail companies will maintain 2 sets of records. They'll keep dual records. One set will be at cost and the other set will be at retail. So retail companies will keep retail and cost values. Inventory is at both retail and cost. So if any of you work in a retail outlet right now, you know that when you count the physical inventory and you extend that by its value, you use the selling price, so you're using retail. But somewhere in the organization, someone knows the cost of those items. So under the retail method, we estimate ending inventory at retail, and then rather than using a cost ratio or a cost of goods sold percentage as a deflator, we're going to use what is known as a cost to retail ratio. And we calculate this cost to retail ratio as follows. We take the ratio of the cost of goods available for sale at cost and divide that by the cost of goods available for sale at retail. So it's very similar in its methodology, except that rather than using the cost of goods sold percentage, we use the cost to retail ratio as our deflator. So in the gross profit method, what we did was we took sales at 100,000, that's a retail price, and we deflated that by the 60% gross profit. The 40% gross profit minus, or I should say 1 minus the 40% gross profit to give us the 60% COGS ratio. Here, we have to calculate our own cost to retail ratio. So again, here you've got the cost of goods available for sale at cost, divide that by the cost of goods available for sale at retail, and we get the cost to retail ratio. So in our example, let's assume that Slatsky Stores reports sales revenue for the period of 40,000. In this case, we also know that we've got beginning inventory and net purchases at both cost and retail. And again, the company needs to keep inventory records on both a cost and a retail basis. Goods available for sale at cost is 100. At retail, it is 170, and the cost to retail ratio is 59%. To calculate the ending inventory, using the retail method, the estimation is done as follows. You have your goods available for sale at both cost and retail. As I said before, we assume that sales were 40, so just looking at this column, the retail column, It's beginning inventory plus purchases, goods available for sale, subtracting out what you sold, almost like the cost of goods sold, except everything is at selling price, gives you the ending inventory. So realize that on this retail column, you're doing nothing but calculating ending inventory by using a standard cost of goods sold formulation, except that everything is at retail prices. Beginning inventory plus purchases, goods available for sale, subtract what you sold. Rather than the cost of goods sold, you subtract out the retail method or the retail value of what you sold. And of course, the ending inventory at retail is estimated at 130, and the estimated at cost would be to multiply it by the cost to retail ratio. So your estimated ending inventory at cost here would be $76,700. So the two ways that we can estimate ending inventory would be to use the ratio of cost to retail under the retail method and the cost of goods sold percentage under the gross profit approach. And summarizing this, if we go to the whiteboard, we're going to find that, again, the estimation techniques are very similar, so that if we use the gross profit method, our cost percentage is the cost of goods sold percentage, and that is 1 minus the gross profit percentage. And under the retail method, our cost percentage is the cost to retail ratio. And that is the cost of goods available for sale and this is the retail value of goods available for sale.